Good morning, everyone, and welcome to another RF Crypto video. Today, I want to speak a little bit about the Federal Reserve rate hike that is going to take place today, Wednesday, the 15th of June. The Federal Reserve has been handed a very difficult task to fight the very high inflation that is taking place in the US. It's now standing at 8.6%, which is the highest it's been in the last 40 years. Basically, the cure for inflation is to increase interest rates, because when you raise interest rates, the cost of borrowing money becomes lower, and if you have money in the bank, the interest that you earn from keeping that money in the bank increases. So with more cash held in bank accounts and less being spent, money supply tightens and the demand for goods drop while the supply remains the same. So lower demand for goods with a steady supply should make them cheaper, and cheaper goods means that inflation will be lower. For context, global stock markets have turned distinctly weak. The mother market on Wall Street is in the bear market territory, with the S&P 500 falling more than 20% and Nasdaq over 30% down from their respective peaks. The dominant trigger for this weakness is the rising inflation in the US, which, as I said before, is standing at 8.6%, coupled with a hawkish Federal Reserve expected to get more hawkish to sound more credible in its fight against inflation. So they have tried raising interest rates before in order to reduce inflation and control it. However, they have been quite unsuccessful in controlling this inflation, and it still stands high at 8.6%. So with such a high rate of inflation, the Federal Reserve Bank is likely to take a relook at its 50 basis points rate hike guidance. So it wanted to raise 50 basis points every time they met. But because inflation is so aggressive, they have readjusted this, and it is expected with 95% confidence level that the Federal Reserve will increase interest rates by 75 basis points. And the present trend indicates that the Fed will continue with its aggressive tightening, and its main aim is to raise the federal funds rate, which is the main interest rate, to 3.5% or 3.75% by mid-2023. And remember, it was close to 0% during COVID. So this increase is massive. Now, with a tightening monetary policy and with rising interest rates, there is a risk of recession due to a decrease in economic activity. And the probability of an aggressive Fed pushing the US economy into recession has increased to around 60%. Well, the US economy is strong now and the labor market is tight, but a 3.5% terminal rate has the potential to push the US economy into a recession, which will impact global economic growth. Because remember, whenever the US sneezes, the rest of the world catches a cold, just like in 2008. Although there is a probability of recession, and quite a high one, some people still don't believe that a recession will come into play. However, markets have not yet discounted a full-blown US recession and its impact on corporate earnings. So, unless inflation shows signs of peaking and declining, the bearish trends may persist, because this will cause the Fed to increase the interest rates more and more, which will cause a drop in economic activity and a drop in the growth rate, so far that it will turn into the negative territory. And as we know, 2 consecutive quarters with negative growth is considered a recession. We also have the fact that after stocks cratered on Monday, yields on 2-year Treasury bonds rose as high as 3.42% overnight, which briefly eclipsed those for a 10-year Treasury. This is a major signal that bond market investors are more bearish about the short-term economic outlook than the near-term. And with this temporary yield curve inversion, whereby the 2-year Treasury goes above the 10-year Treasury, this is commonly a leading recession indicator. So this very high inflation and a very aggressive Fed is undercutting economic growth, therefore leading to a bearish bond market. And this carnage in stocks will continue until the bond market stabilizes. So there is another concerning sign for investors, which is that the dollar has posted remarkable strength over the past 2 days against currencies such as the yen and the euro. And this unstable foreign exchange markets have been a common feature of every significant global market dislocation or recession since the 1970s. So all the factors are pointing towards a recession. However, it might not reach that point, but the risks are there, and the whole world should brace themselves in case it happens. Also, there is a fact that almost $100 million exited the US crypto funds in anticipation of this hawkish monetary policy, or the 75 basis points increase in the interest rates. So institutional investors offloaded almost $102 million worth of crypto assets in 1 week in anticipation of this increase in interest rates, and products offering exposure to crypto's two major assets, which are Bitcoin and Ethereum, accounted for nearly all outflows at almost 57 million and 40 million respectively. The month-to-date figures also paint a grim picture at $91.1 million worth of outflows for Bitcoin products and 72 million in outflows for Ethereum products. So what pushed Bitcoin into a crypto winter over the last 6 months can by and large be explained as a direct result of an increasing hawkish rhetoric from the US Federal Reserve. And this makes sense because if the Federal Reserves increase interest rates, loans get more expensive. And when loans get more expensive, people are less willing to take out loans. There is less free money in the markets for people to play around with. So during the pandemic and when interest rates were close to zero, we saw an explosion in the price of cryptocurrencies. And this was simply because there was a lot of free money in the market due to the fact that interest rates were so low, so money was cheap. Interest rates are the price of money. At that point, the stock markets were already heated up and at all-time highs. So investors looked for alternative assets to make money from, to generate fantastic returns. And they turned to crypto, which they poured money in and caused the global crypto market cap to go as high as $3 trillion. For comparison, now it's standing at 860 billion. So this lack of free money in the market and an ever-increasing interest rates is putting a lot of pressure on the crypto markets, and that's why we have seen a bleeding from the crypto markets. So if you watch yesterday's video, you will see that the current crypto crash was caused by Lido Finance's staked Ethereum depegging from Ethereum. However, the Federal Reserve's hawkish stance in terms of interest rates and monetary policy is adding fuel to the fire and causing the crypto markets to crash even further. So just have a look at any Bitcoin or Ethereum chart and you'll see that it's just red candles all over the place. Everything is pointing towards a decrease in prices due to the fact that these factors are causing a very, very high selling pressure in both stock and crypto markets. And we know that whenever the stock market goes down, especially the Nasdaq, the crypto market follows. We have seen a 30% drop in the Nasdaq in the last week. It translated into a 30% drop in the crypto markets. We are very much in a bear market. It is in the bearish territory. It is very hawkish. Everything seems to push the prices down. We might see a recession. We might not see a recession, but the markets are suffering at the moment. They might continue to suffer until the conflict in Eastern Europe is over. So for now, we should just buckle our belts, invest in projects that we believe in and that will survive this bear market, because then will be the time that we can reap the returns, because money is made during a bear market when everything is down. So keep that in mind, do your own research, have a look at different projects, see their perspectives, see their team, see what their value proposition is, see what they can offer to the markets, and put your money accordingly. But we have always had crashes, we have always had recessions, and I believe that because the economy is evolving and is becoming more digital, it will come out stronger than it was before. With that, this is the end of today's video. Thank you very much for watching. If you enjoyed the video, please leave a like, hit the subscribe button, and share this video with your family and friends. Invest wisely, and cheers.